Most investors think they're smarter than the market, and statistically, almost all of them are wrong. We're about to get into one of the most quietly brutal debates in personal finance. Do exchange-traded funds actually beat stock pickers over the long run? And why does the answer make so many people deeply uncomfortable? Let's set the stage. In any given year, roughly 80% of actively managed funds fail to beat their benchmark index. That's not a bad week or a rough patch. That's a structural, repeating pattern that has shown up decade after decade like clockwork. Think of the stock market like a poker table, where the house takes a cut on every hand. That cut is fees, taxes, and trading costs. And it slowly bleeds even the sharpest players dry. ETFs, by contrast, are like just buying the whole casino, which sounds boring until you realize the casino almost always wins. There was a moment in the early 2000s, and again around 2021, where retail investors genuinely believed the game had changed. Meme stocks, Reddit threads, and zero-commission apps made stock picking feel like a superpower. But the hangover from those highs revealed an old truth. Conviction without process is just expensive entertainment. Warren Buffett himself, arguably the greatest stock picker who ever lived, told his own trustee to put 90% of his estate into a low-cost S&P 500 index fund after he's gone. When the Oracle of Omaha is essentially saying, "Don't do what I do," that's either humility or the most important financial confession of the last 50 years. Historically, the data from Standard & Poor's SPIVA reports shows that over 15-year rolling periods, more than 92% of large-cap active fund managers underperform the index. Not occasionally, not in bad markets, but consistently. And yet the financial industry continues to sell the dream of alpha like it's a sure thing, because, well, your optimism is very profitable for someone else. Here's the irony that should make you laugh and cry simultaneously. The more information we have access to, the harder it actually becomes to beat the market, because everyone else has that same information too. Price discovery is so efficient now that by the time you've read the headline, the trade has already happened 3,000 miles away on a server farm in New Jersey. A common misconception is that ETFs are just for passive, boring investors who don't care about returns, but sector ETFs, thematic ETFs, and factor-based ETFs can be used with just as much intentionality as individual stock selection. The difference is, you're diversifying away the single stock blow-up risk that has destroyed more retirement accounts than any market crash ever has. The practical lesson history keeps handing us, absolutely free of charge, is that time in the market consistently outperforms timing the market. A boring, automated monthly contribution into a total market ETF started at 25 beats. Almost every heroic stock picking strategy started at the same time, not because of genius, but because of discipline and compounding. Position, size, and consistency matter infinitely more than being right about any single stock. And this is where most retail investors quietly sabotage themselves. They go heavy on conviction plays and light on boring compounders, which is essentially betting your financial future on a feeling. There's a philosophical truth buried in all of this data. Markets are a collective mechanism for humbling overconfidence, and they are extraordinarily good at their job. The investors who do best long-term aren't the ones who found the next Amazon. They're the ones who didn't panic sell the index in March of 2020. If you run the numbers, a $10,000 investment in an S&P 500 ETF in 1993 would be worth roughly $230,000 today, with dividends reinvested, no stock picks, no research, no late nights reading earnings calls. That's not a consolation prize. That's the whole point. So do ETFs beat stock picking long term? For the vast majority of investors, individual or professional, yes, and the margin isn't even close. The beauty of accepting that isn't defeat, it's freedom. Freedom from the anxiety of being wrong and permission to let the market do the heavy lifting while you focus on earning, saving, and living. Whether you end up in ETFs, individual stocks, or some thoughtful combination of both, the real edge isn't your stock screen, it's your behavior, your patience, and your ability to stay in the game when everyone else is running for the exit. And if you're ready to put that same disciplined thinking to work in real estate investing, home contracting, or finding the right lenders? Check out our links in the description below and let us help you get started.